Why I never freak out about the real estate market. Most experts out there seem to have different opinions on the real estate market. Some say it's going to crash and go down. Others say it's going to go up. Some say some areas will grow and other areas will go down. And many just sit out because they can't figure out really what's going to happen. So let me tell you why I don't get all freaked out or riled up whether the market's going up or whether the market's going down, and how I handle my investments during those periods. Okay, so the first thing you've got to realize as a real estate investor is you're always going to be solving a problem. Whoever solves the most problem is the one that's the best real estate investor, and in turn is the one that's making the most money. We are real estate problem solvers as investors, and what that is not solving our problems, it's solving other people's real estate problems. I am an expert at solving real estate problems, and there's a lot of them out there. Let's talk about this just for a minute. You're going to have one of two problems no matter what. Properties are going to be easy to find, but they're going to be hard to sell, okay? These are going to have an inverse relationship. Now, the opposite of that is they are going to be hard to find. That will make them easy to sell, okay? You're always going to have, there's this pendulum, I guess my little thing here. So either one's going to be up and the other one's going to be down. And if this one starts shifting, very rarely is this their equilibrium where it's like, oh, it's going to be the same. It's usually easy to find or hard to sell. Let's talk about what does this actually mean. If you can go out there and you can get sellers to sell you a property at a discounted rate that you can fix up or you can wholesale, you're going to have an easy time finding them. You're going to have a really hard time selling them because everybody else can try and do the same thing. So there's going to be less buyers than there are sellers, which means it's going to be harder for you to sell that property. In the reverse, if it's really hard to find properties, it's going to be very easy to sell properties because everybody wants those properties, but they're having a hard time finding them, which makes it easy to sell. The important thing is that you need to realize how to make money no matter what market we're actually in, whether it's easy to find or hard to find or easy to sell. You've got to be prepared for that. Now, one thing I see a lot of mistakes being made, especially as the market is changing. Right now, we've gone through from a hard to find and easy to sell where we're starting to get into an easier to find and harder to sell. One thing you've got to keep in mind here when we're dealing with property values that are declining, let's talk about this. So if the property values in your area are going up or if they're going down, let's just look. This is property values. This is my beautiful graph because I'm such an artist. Okay, so if property values are going up, I always look at 3 actives and I look at 3 solds. Typically, if the value is going up, if you're seeing things go up, the actives are typically more money. They're listed for more money than what the solds are. So let's say a sold for that property was $100,000. You might see an active at $103,000. Okay, for the same house, like for like, okay, or as much as possible. Why is that? Because the market's going up, and so you've got people that are listening saying he sold for $100,000. I'm going to try and get a little bit more and sell for $103,000. And if the demand from buyers is there, then there's a good chance he'll end up getting that. Well, then what happens is then the next guy says, well, he sold for 103, so I'm going to put it for 106. Okay, so you're going to keep seeing these actives looking at what is happening in the market. It's appreciating in that area. So what I like to do when I'm valuing properties is I like to look at active properties and look at sold properties. Let's look at a declining market and talk about the same thing here. So if the market is going down, you're going to see the opposite effect here, okay? You're going to see solds here, but you're going to see actives for less money, okay? So basically you're gonna say, well, this property sold for $103,000. Okay, but guess what? The same property, similar, same for same, like for like, is for sale for $100,000, okay? Because what they're saying is the market's going down, and then what's gonna happen is if that sells for $100,000, then you're gonna see the next one go active for $97,000 or $95,000, right? Because we know the market's going down, and so everybody's trying to stay ahead of that market. But one thing you've got to realize with these actives is this is their asking price. there is typically going to be some negotiating room in there. So somewhere between 3 to 5% in negotiating room, and it could be more depending upon what's actually happening in the marketplace. So the lesson to learn here is you need to be looking at sold properties, and you need to be looking at active properties that are like the property that you're looking at investing in. You want to make sure that you're being a detective, you're looking at everything, and you don't have biasness towards the property or towards the investment you're trying to do. If I know the market's heading up, I am going to look at sold properties, and I am going to have my property values based upon sold properties. Now you're going to say, Ryan, if the market's going up, I should be able to sell it for more than what sold for. And the answer is yes, you should be able to, but you never know. So let's use solds. We can price it a little bit higher, but if we end up not getting that property sold, we know exactly what we need to bump the value down to get like for what other properties we're actually selling at. Likewise, when a market's on its way down, I value my property not based upon solds, but I base it based upon actives or active properties that are out there. And I then take a 3 to 5%, sometimes even a 10% deduction from the active for negotiating room, because I am looking at the market actually trending down. Okay, so the moral of the story here is you want to price your property for the lower of the sold or the actives. Okay, so whatever is the lower price is what you're going to want to sell or list your property for, or plan on that being your sales price. You don't necessarily have to list it at that. And you want to make sure if you are using the actives, you're taking off some negotiating room in addition to that. So let me say that again. You'll price your property for the lower of the sold or actives. And if you're using actives, you take a 3 to 5% deduction for negotiating room off that active. And that is the price you should be planning on selling your property at if you're going to be selling a property. Now, the other thing to keep in mind, as markets change and as markets shift, what you have to do is potentially shift your strategy. One of the great things that happened, I've been investing in real estate since 2000, so about 22 years now. One of the things that I've noticed is as we had these 2008 crash, probably the biggest real estate crash of all time, one of the things that I noticed is the recovery was a lot faster than people realized, and I noticed that rents actually went up. So you had a little bit of rents go down, and then it went skyrocketing back up. So it may be a great idea to actually change your strategy, and instead of going after fix and flips or wholesales, maybe you should be looking at doing what are called BRRRR deals. BRRRR deals is where you buy, you renovate, you rent, and you refinance the property and keep that property as a rental property. Now, you're gonna say, well, Ryan, that doesn't work right now because interest rates are on the rise. I know that, I realize that, but guess what? Sometime in the next 10 years, interest rates are gonna come down too. So if you can get to break even or maybe a little bit of profit when interest rates are on the higher side, once they're on the lower side, you've paid down a little bit, or your tenant's paid down a little bit, then you can refinance and you will have more cash flow than you know what to do with. So I think that's a strategy that you should also be looking at. Now, let's look over here and show you some of these rents. Okay, so here is one of the things that talks about what happened to rents. These are median monthly rents over historical time. So you can see back in 1940, the rents were about $27 a month. And you can see right now for that same property, the average rents are $1,104 per month. Maybe I shouldn't say same property. I should just say what rents are because it's not necessarily like for like. But what I want to show you here is during the 2008 crash, you can see from 2005 to 2010, rents went up, okay? There was a little bit of a blip for a minute, and then they just kept going up 2005 to 2002. So what happened in 2008, they went down just a hair for maybe a year, and then they started just going right back up. Well, you're saying, well, Ryan, why is this the case? Well, people were losing houses. They needed somewhere to live. So most people just downgraded. They went from a bigger house to a smaller house that was more affordable for them, or they moved in with family members. With that, there weren't as many landlords that had opportunities, because just because the market's going down does not mean that they're not people that need to rent houses. One of the great things about houses is it's a basic necessity, right? So you need food, shelter, clothing. Those are some of the basic necessities of life, and shelter being one of them is rental properties. So as a market continues to go down, if that's the case, you should be looking at changing your strategy. One of the things I like to say, no matter what the market is there's always an opportunity regardless of the market. If the market's going up, if the market's going down, if the market's going sideways, there is always an opportunity opportunity, it's your job as a real estate investor to find what that opportunity is and make the most of it with whatever market you're in. I see a lot of investors that are throwing up their hands saying, oh, there's no sense, there's no use. That's the wrong attitude and the wrong approach. What you want to do is find the opportunity in the current market and play the game. So you play the game based upon the hand that you're dealt, even though your strategy may go a little bit differently, and then over time you can watch these and see how it can make things better in your real estate investing. This is another graph that I think is really helpful as we are looking at what happened during the 2008. You can see here, this is how much change, percentage change happened in rents that were actually there. This is no change at all. So you can see coming in 2005, rents went up considerably, and then they start leveling off or coming down. Now you can see in 2009, rents went to about a 4% decrease in rents. And then right after that, they skyrocketed back up to about a 4% increase, and they have continued up since that point in time. But if you think about this, all we're talking about here is a 4% less in rents, okay? So if the rents were $1,000, the rents are now gonna go down to $1,060, $960, and you're gonna lose about $40 a month, okay? So you're not talking about significant downturn, especially if you deal with an economic crisis, a real estate crisis, and I don't think you're going to be seeing that for some time again, based upon some of the things that happened. You see, after the 2008, they came out with the Dodd-Frank Act, and the government basically said, you know what, we're going to be more cautious because they got a lot of blame for what they did in the subprime markets and packaging up subprime loans and pretending like they were great loans. With that, they said, we're going to do what are called stress tests on banks because we want to make sure that a bank can handle going through a 2008 again. And we're going to periodically be stress testing the bank to make sure financially they're solvent enough to go through those so we don't deal with another real estate economic crisis. Now, that's the theory behind it. And so far, I think it's worked fairly well. Okay, so this is a graph of interest rates over time. You can see what's happened here. So interest rates in the 1950s were around 2%. You can see in the 1980s, interest rates hit 17.5%, 18%. This was a horrible time. This jump from here to here happened in about a year. And if you were doing a construction loan during this time frame, you were in bad shape because back then when you did construction loans, you actually couldn't do a one-time close. You had to do two separate closings. So someone that went in and said, okay, I'm going to buy a house, and they were planning on a 7% rate. By the time the construction was done, it was a 17% rate a year later, and they couldn't afford it and had to just let the house go or get foreclosed on. Crazy times. I don't think we're going to see those again. But if you look here, 2005, you can see that the Federal Reserve started raising interest rates to somewhere around a 5%. Now, when 2008 hit, you can see they drastically cut interest rates and kept them really low. Now we're seeing interest rates they went up again, they went down because of COVID and those things, and we're starting to see a drastic incline back up. I don't think this needs to be a surprise for us right now. Now, this is the federal funds rate. This is not what you're going to go borrow at. This is what the banks borrow against the Federal Reserve at, but this has an impact on our interest rates as somebody that's an investor or a home buyer. And the reason for that is the banks are going to borrow at 2%, 3%, 5%, and they are going to add on a couple of percentage points, and then they're going to sell it to us for a few percentage points more. So for example, if the federal rate was 5%, they may add 2 points called their margin on top of that, and you would see the effective rate that you're paying is about 7%, 5% of what they're paying the feds, and a 2% margin they add on top. And that's how banks make money, is they borrow low and they sell high. That's basically what happens, and they're borrowing from the Federal Reserve. Okay, so a couple of points I want to make sure that we're realizing here. Number one, there's opportunity in every single market. Whether it's going up, whether it's going down, whether it's going sideways, it's your job as a real estate investor to solve problems for people that will get you the most and help with your strategy and help them out in the process. Now, the next thing we've got to talk about here is what strategy, if it's going down, we talked about ways to value properties. If property values are going up or property values are going down, ways that we can value properties. The other thing we talked a little bit about rents. What happens with rents during a 2008 2008 crisis. How much do they really go down? Well, we're saying they go down about 4 to 5% is what we've seen historically in 2008. The other thing that we saw after that, though, is rents skyrocketed after that, and they've been skyrocketing ever since then. So it's something to keep in consideration where you may want to be trying out a BRRRR strategy in this type of marketplace. But no matter what, I think the important thing is that you never stop investing. A lot of people stop investing, and that is the wrong thing to do. What you need to do is find the opportunity in the market you're in. You need to change your strategy of how you're investing. So you need to realize what's the best thing, how to do that, and what you need to do to be successful regardless of what's happening in the market as a real estate investor. Now, I put together a video on the 13 steps to successfully fix and flip. Now, that works in any market as long as you're using these principles we talked about. We'll talk about setting up your roadmap to get your very first deal. We're going to go through what are the most overlooked parts of a fix and flip and things you need to be aware of. Check it out. Click on this video. You're going to love it and make it a very profitable day.